Crypto markets finally stage a strong rally after being bombed out for weeks. ETH drives the optimism as a September merge date looks more likely. Vol catches a bid and skew flips towards the call side, especially in ETH. All this and more in this week's Crypto Insight. Okay, so crypto this week. We had thought that Bitcoin had kind of completed the fourth wave correction, right? And this was, a couple of weeks ago, about 10, 11 days ago. And then it started its downtrend again. And we were like thinking that that's the kind of next impulse wave lower. We're probably going to break the lows, and then we're going to, if stocks sell off as well, that we're going to head lower, right? And to an ultimate target of, maybe 12K, 15K, whatever it is. It seems that was wrong, and we've now reversed back higher. And so this fourth wave, this corrective pattern still is ongoing, okay? And if it has got further upside, and I was looking for it to confirm that further upside, I was looking for a break of maybe 20, sort of 2.5, which we seem to be doing now. Then it's potentially got legs up to this midpoint, right, of this crazy candle down here at around 25K, right? So we may need to extend this fourth wave corrective bounce up towards the mid-20s before we resume the downtrend, right? I still believe the downtrend's intact because the down moves are so much more impulsive than the up moves up till now. Now that may change, right? But for now, the technical structure still seems to be a downtrend is in progress. The up moves are corrective, and at some point they'll get exhausted and we will resume the downtrend, right? So that's still my base case for Bitcoin. Now, I have been running some risk reversal hedges against some of my Bitcoin exposures, not in the whole size, because I wanted to have some participation in case Bitcoin bounces. And I haven't been running any extra sort of leverage short calls or anything like that, because I had been nervous that the price action last week, the decorrelation that we were seeing between stocks and crypto was smelling like crypto wanted to bounce because it was pretty bombed out, basically, right? So obviously the catalyst has emerged in Ethereum, okay? And that's the headlines that this merge might be happening in September. So we mentioned last week, that they were going to do another sort of testnet merge, likely in the next sort of 3 or 4 weeks, sometime in August. And then we didn't know what date they were going to put out as your actual, main event for the merge. But one of the developers basically put out 19th of September as a date. Market kind of, held on to that fact, and we had a proper charge, right? And in the Vol dashboard last week, in the rundown on Friday, I'd said if we broke above 1300, then ETH was going to have a go, right? And we've obviously gone pretty quickly to around 15.5 since then. Yeah. And that's been through that catalyst. So again, I was nervous looking at that price action on Friday, seeing that price action in the face of equities not doing a lot, thinking, okay, you don't really want to be caught short too much upside here. Covered a load of July calls. Unfortunately, didn't go long, but at least covered the shorts. Saved myself a ton of money on that rally, which is good. But I do still have some August short 15s, but again, not in my whole size. So protecting some of my exposure, but because they're August, I'm kind of leaving them. I'm long some downside. So I have got some risk reversals, but like I said, in a portion of my size of my holding.
So basically, starting with Glassnode, their general theme for their analysis this week was trying to gauge whether we've seen seller exhaustion, signs of seller exhaustion. And the main way they're doing this is looking at realized and unrealized losses to try and gauge previous seller exhaustion points in previous bear markets. So starting off first with the realized price and the NVRV model. Realized price is just sort of, so you have the realized cap, which is the aggregate value of all the Bitcoins last time they moved on chain. So if you take that and divide it by the supply, that's going to give you the realized price. And then the MVRV is the market value to the realized value. So by overlaying these in this chart here in the top left, this line here, this orange line, that's the realized price, which is hovering around 22,000, I believe 22,092, right around 22,100, which obviously between yesterday and today, we've kind of been popping our head above and below. But as you can see, kind of looking at previous bear markets, the 2015 and 2018 mainly, when we trade below that realized price, it tends to go a little bit further down. And for a decent amount of duration, it's not just a quick down and then back up. I believe right now we've been under that realized price for about 35 days. But if you go to these previous bear markets, those were 134 days and 300 days respectively. The only time where it was a short time under that realized price was that COVID flash crash, which I think, we can safely say we're not really in a severe panic moment like that right now. So it would seem we're more conducive to compare to these other bear markets. And then on this same chart, we have this oscillator for the MVRV, the market value to the realized value. And so when you have this orange, it's basically showing you that it's above 1. So you have that the market value being more than the realized value. And then the flip is the opposite's true when you're in this red, you're below 1, that realized value is worth more. And so you can see right now we're in that regime where we're below 1 on the MVRV, but it's not very low and it hasn't been a long time when you compare to these previous bear markets. So again, it kind of points to that feeling that yes, we're kind of getting towards that seller exhaustion, that point where there's not really any sellers anymore and we can start to move our way back up, but perhaps it just hasn't been enough duration yet. So moving on from there, the top right, we add to in addition to looking at the realized price, we're looking at the balance price and the delta price. And so the delta price is just that realized price that we just spoke about minus your all-time average price, right? You have your 30-day moving average, 50-day, 200-day, whatever it may be. You also have your all-time average price. So if you take the realized price minus the all-time average price, you get the delta, which right now is right around 14,215. And then you also have the balance price. So balance price, once again, looking at that realized price minus the transferred price. So I did have to kind of do a little bit of a self-education, a little bit of research to figure out what transferred price was exactly. And I'm going to do my best to make it real simple, basically being the transferred price looks at the coin days. So we spoke about it before. When a coin moves to a new address, a new wallet, it starts counting how many days it's been since that coin moved. That's a coin day. And then when that coin is moved, that's coin days destroyed. So basically the transferred price looks at the coin days destroyed, multiplies it times the value of Bitcoin at the time, and then adjusts it based on how long the Bitcoin network has been up and how much supply there is. And it basically what it gives you is a realized price, what you paid, minus the value of what was transferred. And so the reason this is important is because when you look at these all together, you can kind of see that they help kind of map and bottom formations in previous bear markets. So what you could see if we zoom in here a little bit, I'm not able to zoom in, but when you're able to look a little more closely, you could see these blue areas are these former bear markets. And the sort of the pattern you see is you see a spike down to the delta price and then an accumulation between the realized and the balance price. It happened here in 2015, then it happened again in 2018. The COVID crash obviously was a little bit different. All it did was wick down to the balance price. But right now, it would seem that we're in sort of this regime similar to previous bear markets, where we're accumulating, bouncing up and down between the realized and the balance price. So it would seem we just need a bit of a wick down to this green circle you might be able to see here, down to the delta before we can move our way back up and be in line with previous bear markets. Moving on from there, looking beyond just sort of the realized price-based metrics, we're looking at the percent of transfer volume and profit. So of all the coins being transferred on chain right now, how many of those coins, what percentage of those coins are actually in profit? And what you can see is, again, we have in previous bear markets, a pretty common structure that tends to form, right? It kind of oscillates, it coils and gets into this tight window, and then it breaks above. It did it leading into 2015, it did it leading into 2019, and we're in a similar structure now. And basically what we're showing here is in this green area that they marked off, that's where you get to around 42% of the volume being transferred being in profit, which obviously on the flip side, that means 58% of that volume is in loss. And so that 42% is kind of the area they marked off as being significant in previous bear markets. It did get a little bit lower in both of them, But where we are right now, we haven't even kind of gotten down to there yet. The lowest we've gotten is 46% of volume in profit. Obviously, the other side of that is 54% in loss. And so it would seem congruent with the other two charts that we would need a little bit more downside. But Glassnode did point out that they feel if we did start to see kind of a strong move up out of this sort of coil, that they feel that could be enough sign that seller exhaustion has taken place. And the last chart on the right here, once again, staying with trying to find signs of seller exhaustion, we're looking at the realized cap hodl waves. Again, a quick reminder, the hodl waves, it's just looking at where it's a supply dynamic model where you're looking at the different ages of the coins, how old are the coins being held. And so this particular hodl waves chart, we're only looking at coins that are being held for 3 months or less. And Glassnode calls this hot money. And so basically what you're seeing is that you're getting a pretty obvious and significant downtrend that we're in right now, and it is congruent with past bear markets, basically showing that it indicates two main things: that the older coins aren't selling as much, right? Because if the older coins are selling, that would mean the younger coins are buying, and you would see an increase in these bands. And then also in that same realm, long-term investors are just continuing to accumulate. The hodlers are continuing to be strongly convicted, and they're absorbing these young coins being sold, holding them in cold storage, taking them off exchange, whatever it may be, giving them time to mature and to age. And so right now we've recently crossed this significant line where less than 20% of the coins now are being held by hot money while it's less than 3 months old. And I didn't feature the chart, but Glassnode did feature pretty much the exact inverse of this chart, showing coins only older than 3 months. It literally looks exactly the same, but flip the colors and everything's up at the top, basically showing that if you can look here, you see we are below that line, but in previous bear markets, it went a little bit lower and a little bit longer. And the inverse of this chart is showing the same thing. And that was really my takeaway for all of these, is that it does seem to be that we're really kind of hitting these points where we are starting to reach seller exhaustion, but it does appear that we need a little bit more duration, a little bit more time in these lower ranges before we can accumulate, form a bottom, and move back up. Moving on from Glassnode, real quick with Will Clement's Bitcoin on-chain, he did mention that he didn't feel a lot has changed. He felt everything's kind of in the same spot, but he did make a couple notes regarding some miners, which I thought were interesting. So that's what I've got for you here. The first being regarding hash ribbons. So hash ribbon is related to the hash rate. Your hash rate is just your daily calculation of the number of blocks that miners are finding each day. And so what you can do with the hash ribbon is you apply the moving averages. So you have the 30-day average for the hash rate and the 60-day average for the hash rate, and overlaying them creates a hash ribbon. And so the general consensus or feelings or thoughts inside Bitcoin is that when you have the 30-day hash rate cross below the 60-day hash rate, it tends to signify bearish momentum within miners, right? So because when you have that hash rate coming off, the closer to now hash rate coming off, that signifies that machines are coming offline, which is known within the miners as capitulation. And also when that happens, you also tends to be associated with miners selling coins, which we can see in the bottom two charts here. So not only are miners coming offline, but you can see here the net position for miners recently went very red. And then also here on the right, you have the coins, the volume of coins going from miners to exchanges. Again, a big spike across all these different miners. It is worth noting that you could probably tell that these behavior did recently flip a little bit. We went green here and it came down. But one thing Will Clement did note is that there's not really any reason to believe that the miners are no longer under stress and that they're just cooling off a little bit, especially considering this downtrend in the hash ribbon. It would still seem that we're in an ongoing miner capitulation, and you're probably going to want to see this 60-day hash ribbon cross back above the 30-day hash ribbon before you can get feeling bullish in regards to miners, which you could see here previously. When it does cross the 30 over the 60, it does seem to signify a little bit more bullish momentum within the miners. And that is this week's on-chain.
Okay, so if we look at vol, what we're seeing in realized. So realized vols, they were pretty low at the start of last week. Bitcoin down to about 60, ETH kind of sub 80. And then, implied's caught a bid ahead of the CPI. Yeah, so the implied realized spread got pretty high, right? It got to 20 to 30 range. into that print, which it often does because the market expects a bit of a move on that print. And then it converges pretty quickly. So you can see the yellow line collapsing towards the pink line, convergence between implied and realized as the event passes and as we head into the weekend and we get the DOV flows suppressing the weekly gamma, and that all comes in. And then obviously we had the explosion higher in spot over the weekend, and that's where implieds have caught a bid again. So implieds in Bitcoin jumped. They're trading at a bit of a premium to realize, but then interestingly, ETH, whilst the implieds jumped from 80 to like 110, the realized jumped even more, right? Sort of low hundreds, sorry, the implieds were at. So you're actually seeing the gapping up in spot just so fast that implieds can't even keep up with it, which is quite unusual, right? And all it kind of suggests though is that the street is relatively well supplied in gamma. So they're not just like panic paying up for it basically, right? You know, and that's partly because a lot of the systematic flows in the market do sell those calls to the dealers and to the market makers, right? So maybe they've got a bit, if it had happened to the downside, you would see vol really explode and trade at a premium to realized. Whereas on the upside, even though it's gone up because the gamma is good value, it's not exploding to the same extent as it would have done on the downside that we saw back a couple of months ago, basically. And then there's a huge realized spread between Bitcoin and ETH, right, of around the order of magnitude of around 40 vols. And this is what I've been banging home week after week, is that even though Ethereum trades above Bitcoin, it is the better value gamma, basically, right? So if you're going to buy short dated vol, it's, even though you're paying up more for Ethereum, it tends to move a hell of a lot more, right? And it's proving itself right now, okay? So that's what I'm seeing on realized. If we then look at term structures and what the implieds rolling out the monies have done, you know, no surprise, you can see the curve inverting. Bitcoin at the top went from contango to inversion, front end trading at around 80. And you can see over the course of the week, you had the pink line is the shorter dated, the weekly, that traded. So you had an inversion of the curve going into CPI, collapsed into contango going into the weekend. And now it's a mild inversion with that pink line shorter dated back above, okay? You look at Ethereum, same story, but much more extreme inversion with the front now at 110. And same sort of story in terms of what the kind of different rolling maturities have been doing. But yeah, that very steep inversion on Ethereum, you know, likely to see some selling as we head into the weekend if the market does stabilize and that flow comes in. So there may be a short-term opportunity to sell ETH gamma at 110 to buy it back at 90 or something like that over a couple of days. Personally, I'm not really playing it just yet. I'm going to let this, I've got this short position already, right? If that weekly gets whacked, then my call ratio actually makes money anyway that I'm sitting on. So I don't really need to go and smash out a load more short-dated Ethereum vol right now. Yeah. Okay. And then if we look at skew, that's really where the interesting thing is. You know, I'd flagged in the dashboard, like I said last week, that, you know, we had skew at around 10 vols on both Ethereum and Bitcoin for the puts, right? And it kind of didn't make sense to me that Ethereum puts were trading like the longer date. You can see here the longer dated, which is the blue line on Ethereum. Ethereum's on the right side, Bitcoin's on the left. So Ethereum, that blue line, that skew was trading a bit flatter, right? A bit less for puts than the shorter dated skew. The shorter dated skew at the start of last week was at around -15, right? Between -10 and -15, which is similar to where it was for Bitcoin skew. That didn't make a ton of sense because your gap risk, your catalyst risk was on the upside for ETH. So I didn't really understand why the short dated skew wasn't pricing that, right? So what I said in the dashboard, and annoyingly, I didn't put the trade on myself because I thought I was going to have a bit more time to do it, was to do a relative value skew trade, right? Where you buy the calls on ETH and sell the puts. So you're short the skew on ETH, and then you buy the puts on Bitcoin and sell the calls. So you're long skew on Bitcoin, and you have that relative trade where if ETH gaps to the upside, you kick into a load of Greeks and the skew can reprice in your favor and you can make money. But if nothing really goes on and they both trade in line with the way they had been doing, then nothing happens, right? You don't really lose anything, right? That was the idea. The only time you lose is if the market melts down and ETH really sells off much more dramatically than Bitcoin. But the idea was that we were already from quite a beaten up level. A lot of that de-risking had already been done in ETH. So maybe that trade, you know, made sense, right? Annoyingly, it was a great trade. I just didn't get it on, right? So, so that unfortunately, I missed that one. If we look at who did get trades on, i.e. the flows that we saw in the market, unlike myself, there were some people who were buying calls on Ethereum. So you can see on the top bar chart is the Bitcoin flows. We saw put spreads, puts being bought in July. So still seeing ongoing hedging there. But we did also see some call buying, 22K strike calls being bought there. But then the real big volumes, we saw spike in volume, spike in open interest across Ethereum relative to Bitcoin flows. And we saw a huge volume go up in the 22nd to 29th of July expiry in the strikes 1300 to 1600. So basically 1 to 2 week call options are what people were lifting, and they were lifting it in size, right? And they were spending, you know, order of magnitude of $1 million premium or whatever it was, right? So not ridiculously big, but enough to move the dial, right? So some fund got in there and said, right, I'm having a go at this, and has done pretty damn well off it, right? I mean, these things, you know, given the size of rally that we've had, they've easily made 5 times their money on these calls, right? Which is not a bad result, given the spots worked, the deltas worked, the gammas worked, and the vegas worked. Every single Greek has gone your way because vol has exploded on the rally, basically, right? So it's quite nice when you trade an option and every single Greek goes in your favor. It's quite rare as well, but when it happens, it's a nice feeling. So someone's done pretty well off that, right? The only caveat I would make is because they're so short dated, those calls might need to be dumped pretty damn quick if they haven't already been dumped. So it might be a case of, you know, towards the later half of this week, those things get sold. And on top of that, the DOVs come in and sell more. So there'll be quite a lot of selling towards the back end of the week. So I'd be pretty surprised to see Ethereum vol hold up at these levels into the weekend, basically, right? The market needs to really justify it and continue moving violently to justify those vol levels. And I suspect it's going to stabilize. We've had our knee-jerk move. So now I suspect it's going to stabilize. Yeah. And that is it for crypto. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.